Berkshire Hathaway never invests in gold. Warren Buffett, as well as the late Charlie Munger, have shared their principles on point of view on why they don't invest in gold. The reasons are if they consider it as a non-productive asset, it lacks utility, the return is dependent on the next buyer, which means it is speculative in nature, it is inherently costly and very difficult to store, and thereby bringing in a huge opportunity cost. These are some of their views. And they view productivity, cash flow, capital gain over a period of time as something more valuable and productive to humanity. Charlie Munger has various principles when it comes to evaluating any business. Today, let us take one of his principles called as the inversion principle to help us gauge and understand what are the probably tail events that can occur so that the gold prices can really crash. This inversion logic can help us prepare and also anticipate what we should be doing in case we have gold in our portfolio. Stay tuned. If we invert, what could cause gold to correct drastically? Russia's frozen dollar reserves, the euro dollar assets, get released. When those reserves were frozen, it destroyed global trust in Western custodianship. That fear, if reserves aren't safe, what is? Made the central banks to quietly accumulate gold as a trust hedge. Now let's invert it. If those frozen assets are released, it signals that geopolitical tensions are easing and that trust in the dollar-based system is restored. There's a second order impact because of this. Central banks, especially BRICS, would slow down gold purchases because the sanction hedge motive fades. Global reserves might rebalance toward Treasuries and USD deposits again. The need for off-system gold as insurance declines. Result? Gold demand softens sharply. When trust returns to the dollar system, gold will start losing its rebellion premium. If the Federal Reserve hikes rates sharply, gold thrives when real yields are low or negative because holding gold has no income. Now let's invert it. If the Fed were to raise nominal rates aggressively while inflation cools, real yields rise. Gold's opportunity cost spikes. The second order impact are investors shift from holding zero yield gold to earning 5 to 6% risk-free returns in treasuries or money market funds. Spot gold, USD denominated ones fall. The result, gold corrects hard as both capital flows and sentiment turn against it. When yield return to paper, gold loses its luster. Global coordination restores faith in fiat. If G7 BRICS Plus and oil economies strike a new monetary cooperation for trade settlements on IMF SDR 2.0, then global uncertainty drops. Investors no longer need gold as an alternative trust anchor. The effect is central bank gold buying could cool off. The currency war narrative will fade. Gold demand declines globally. When the world agrees on rules again, gold's role as the referee disappears. If a fiscal discipline returns, if major governments, US, EU, China, suddenly rein in deficits, cutting spending, raising taxes, slowing debt growth, if strengthens sovereign balance sheets, if the effect is there is a lower risk of fiat debasement, the bond market stabilizes with strong real returns. Investors migrate from real assets like gold back to financial assets like bonds and stocks. When governments behave like grown-ups, gold loses its rebellion audience. There is a global deleveraging, a deflation shock. If the next crisis isn't inflationary but deflationary, asset prices, wages, commodity demand all start dropping. Liquidity crunches make people sell everything, even gold, for cash. The effect is forced liquidation of gold positions to raise dollars. The dollar strengthens because it is a global reserve currency, and gold prices plunge in the short term because when the world needs cash, even gold gets pawned. If the central banks become net sellers again, For example, if countries like China, India, Turkey, Poland, and the Gulf slow purchases or sell to stabilize currency, global gold demand from official buyers will start reversing. Supply spikes, ETF and retail holders panic sell. When the keepers of trust start selling trust metal, the crowd will follow. Let us say the crypto achieves true stability. If regulated crypto stable assets like Genius Act backed USDCs become universally trusted and seamlessly used for cross-border settlement that absorbs gold's monetary hedge, the effect is younger investors will start preferring digital trust over physical metal. Liquidity migrates from bullion to chain yield-bearing assets. So when trust can move at blockchain speed, gold's 5,000-year lag will show. What happens if there is a technological or mining breakthrough? If large new deposits of extraction, technology will slash the mining costs, say new refining efficiency or asteroid satellite mining becomes viable, the gold scarcity premium will start cracking. Market will reprice future supply expectations. The gold will start losing its limited supply mystery. When scarcity is no longer needed and there is no scare on the scarcity, the value will start melting.
It is time that we understand how another great thinker and an investor, Mr. Robert Kiyosaki, how would he view the current situation, and if he were taking positions heavily in gold, which is his claim, then how would he approach it? Stay tuned for the next session.